Today we have a very special guest, Jake Brukhman, CEO and Managing Director at CoinFund, a blockchain research company and private investment vehicle focused on the blockchain space. So, Jake, welcome to the show.
Thank you, Jason. Thanks for having me.
Of course. So, can you start us off by maybe walking us briefly through your background, how you started CoinFund, and what was your favorite moment from Blockchain Week?
Awesome. I'm a technologist. I have a background in mathematics and computer science. I worked in the hedge fund world here in New York for about 5 years, doing quantitative research, quantitative trading, and then just generally like financial technology around trading systems. I also worked at Amazon as a technical product manager and engineer, running an ad tech team, also here in New York for about 2 years. And then was a CTO of a smaller company called Triton Research, which focused on financial analysis of pre-IPO tech market companies. I got into Bitcoin around 2011 is when I received my first Bitcoin. Started kind of buying on Coinbase around mid 2013, but it really didn't kind of click for me until I read the Ethereum white paper. And I read that and I felt like the idea that tokens would proliferate and become the early stage economic interest in decentralized networks made a lot of sense to me. And I just simply asked a very natural question of like, why don't people diversify portfolios of digital assets? And that formed kind of the basis for CoinFund. CoinFund became one of the first sort of crypto portfolios or crypto funds in around mid 2015. And then over the course of a couple of years, we accrued some partners and also worked as an advisory team to various companies, including Kick Interactive and YouNow, as well as many different early stage blockchain projects and highly decentralized projects, which brings us to this year where we launched our second fund in partnership with Venrock and continue to invest in this space and work very closely with companies.
Got it. And what was your favorite moment from this past week?
I got to be honest, like as far as conferences go, I actually spent relatively little time looking at talks. I did spend a few moments at talks, and one of my favorite talks was the Dfinity meetup, where they kind of went into a lot of the WebAssembly work that they've been doing, and I think that's actually a really, really exciting development for blockchain in general.
That's awesome. And I'll definitely dive more into both Kick Interactive and also YouNow later. But for now, I'd like to focus on your thoughts on how value is distributed in crypto asset markets, focusing specifically on this dichotomy of utility tokens versus so-called protocol tokens. And so just to start us off, you wrote an article called Fad Protocols Are Not an Investment Thesis, which is a pretty contrarian view in this market, in my opinion. And Fad Protocols is a popular concept for our listeners in crypto investing. So can you first maybe briefly explain to our listeners what Fad Protocols is and also explain what you mean by a functionality stack?
Sure. So Fad Protocols, that concept came out of an article that was written by Joel Monegro. He was an analyst at Union Square Ventures at the time, focusing a lot on the blockchain space. And essentially, I don't think it's a bad observation at all. I think it's a very good observation that protocols within decentralized value networks tend to behave a lot differently than just sort of vanilla protocols that we've seen in the past. And Joel's example is TCP/IP. Let's say has become a ubiquitous protocol. It's really hard to go through your day and not manage to use TCP/IP somewhere, somehow, maybe it's some device or just even directly on by using a computer. However, that protocol does not itself monetize, intrinsically. And so the way that TCP/IP has been monetized is that many people have built, the web and then subsequently businesses and applications on top of the web that use the protocol and then monetize through the services that they provide on top of the protocol. Joel's observation was that in decentralized value networks, like blockchain networks and cryptocurrencies and other protocols that are being built, in fact, you have a native digital asset in these protocols, and that native digital asset sort of reflects, at least theoretically, the utility of that protocol, the utilization of that protocol. And so it's fat in the sense that these are protocols that can be, in fact, monetized. Now, I think that, one of the reasons that I wrote that article is because I noticed a lot of kind of investors coming into the space from a more traditional angle, and coming in from that idea. You often have people thinking about, let us invest in sort of the lower infrastructural layers of new technologies, right? And they really took that idea of Fad Protocols to heart. And the counterpoint that I wanted to highlight is actually that it's a very different environment for protocols and their modernization when you look at blockchain, for many different reasons. One reason is that, unlike in the past, you actually have many, you might say hundreds or even thousands, eventually, of these protocols competing for kind of the same types of use cases. Like if you think about how many cryptocurrencies there are, or if you think about how many, credit protocols or stable coins there are, right? These are all kind of competing for the same use cases. And so, why would an investor say, like, it's better to invest in protocols than to invest in some kind of application built on top of the protocol? If you think about why, well, it might be because they think that the protocols might capture more value. They might think that the protocols might provide more diversification because they're kind of serving a lot of different apps on top. And sort of my point is, it's like, well, it's almost very similar between picking sort of individual applications and picking protocols just by the virtue of the fact that there's so many of them and they compete for the same use cases. And then, of course, the other issue is that protocols in blockchain are incredibly diverse in how they work, in how they accrue value, and how they transfer value from one layer of functionality to the other. And then to answer your last question, what is the functionality stack? I just kind of think of different layers of technologies, right? So you have kind of the very low layers are the infrastructure of the internet. These are just literally the computers that are serving the web and create this kind of like abstract overlay network. Then you have another layer which maybe implements like the TCP/IP protocol. Then you have HTTP on top of that. Then you have web. Then you have applications on web, and so on and so forth. So to me, kind of the higher you go up in that stack, the closer that you get to the mainstream consumer or end user who's actually using real life applications that's built on this like really high stack of protocols and applications. And then finally, like the last thing, the last point of the article is to say, like, well, what really is a protocol anyway? A protocol is just a set of rules that allows kind of two entities on this like digital network to interact with each other. And in that sense, you can abstract many different things into a protocol. If you look at Twitter, right? Well, we think of Twitter as an application, but really Twitter is an API where the Twitter front end is just one application on top of what is really a protocol that implements kind of the Twitter microblogging platform. Just as well as there's the Twitter website, there's also thousands of applications that you can use on top of that same protocol. And in some sense, Twitter is a protocol itself.
Got it. And I know you're not too fond of this differentiation between quote unquote protocol versus quote unquote application tokens. But do you see differences in the way that value is fundamentally driven for a protocol like Ethereum, for instance, or a quote unquote application like maybe like Funfair or even some of the investments you've made?
Yeah, I mean, absolutely. I don't think the line is between protocols and applications. I think it's more that you have different crypto economic systems that you can actually apply in many different ways. There's a set of decentralized systems where we think of utility tokens, right? Utility tokens are, I think, like a really broad term that captures a lot of complexity and is not necessarily like the best term, but in the sense, utility tokens are those tokens that you pay for, in exchange for some kind of service or resource provision on a network. Ethereum is an example where you're paying Ether for computation. LivePeer is an example where you're using LPT to pay for, where you're using LPT to actually ensure the protocol of the nodes on the network. You actually, I think, pay the transcoding fees on live peer in Ether, but the token is used to create a crypto economic system that secures the network. It decides like which validators are going to be the ones actually processing the transactions. It creates incentives for those validators to behave correctly, and so on and so forth. And that's like one set of token use cases. It's like, here I'm using it as kind of an ecosystem or utility currency to buy a service, or I'm using it as a kind of digital asset primitive to secure a network. And then of course you have just like pure digital economy use cases, stuff that Kik and YouNow, for example, are looking to build, where their token just represents sort of the economic activity of their microeconomy.
For sure, and I'd love to focus more on Kik and YouNow later as well. But one interesting point that came up in the interviews that I've done with other VCs in the past, especially for VCs from a more traditional venture capital background, they are very much focused on kind of investing in tokens that they say solve problems at a more infrastructural level. And given that the market itself isn't really mature yet, given that we haven't seen really any decentralized application go fully mainstream, does it make sense for investors to first invest in these based or fundamental protocols like Ethereum or EOS, for instance, and then slowly shift their investment over to more specific use cases in the future? Or do you think this distinction shouldn't be made at all?
That's a great question. And again, I think, like you pointed out, like folks coming from the more traditional sort of investment background probably think along those lines, right? They think back to, the dot-com era, and they think about like building infrastructure first and then apps later. What I can tell you is I think that today in blockchain, there are really interesting projects that are, on the one hand, there are projects that are really close to the base layer, the infrastructure layer, or kind of the middleware layers like decentralized exchanges and smart contract, platforms and stuff like that. But at the same time, there are companies who are, maybe big traditional companies or VC-backed companies or centralized companies that are incredibly interested in this technology and have really good use cases for the technology. But the value proposition there is that where these sort of like base layer technologies and protocols and middlewares really have kind of a limited audience because they're so technical, right? They're really facing like very techie people, very financy people who know how to trade, or they're targeting the developers that are going to be developing on those platforms. But at the same time, I think it's actually a really compelling idea to take a traditional sort of application, something that has many millions of mainstream users. For example, Kik has 300 million registered users on their platform, and YouNow has 40 million registered users on their platform. And to provide them with a blockchain-based product as an experiment to see how mainstream adoption, or at least early mainstream adoption, might take place. And I think that's a huge opportunity. I think it's an experiment. I think that it's timely in the sense that the mind share of blockchain and cryptocurrency has been growing substantially, and so it's not even like a long shot that people might try this kind of technology. And for that reason, as an investor, I think about it both ways. I want to invest in the infrastructure. I want to invest in the middleware, but I also want to invest in like really compelling, what I call consumer proximate, or like user facing mainstream applications that might really be the way that blockchain gets adopted.
Mm-hmm. And this might be a broad question, but speaking of consumer applications, are there applications where a decentralized model are specifically better than their centralized counterparts? Are there specific use cases that really immediately stand out to you as being better addressed through a decentralized model?
So that's a great question too. I can think of a couple of examples where systems have made compromises between like a fully decentralized application and a centralized application. And the two examples that that come to mind immediately would be Leroy.io, which is a decentralized Twitter application, and then subsequently Peepeth, which built upon some of the architecture considerations of Leroy. Both of these are decentralized Twitters. And James, who's the guy who built Leroy as kind of a weekend experiment, he did an incredibly clever thing, which is he said, look, if I'm going to be using decentralized Twitter and Ethereum, I'm going to be having to pay transaction costs for every operation I do. If I create an account, if I post a tweet, if I like a tweet, if I pay somebody a tip because I like their tweet, and so on. And so what he said is, I really want to minimize those gas costs, and he came up with something called stateless smart contracts, which is essentially that, when you make those transactions, the data of your tweet kind of gets recorded on the blockchain, but the method that you call does nothing, and so costs no gas, and so you minimize a lot of gas. And then on top of that, you build actually a full stack centralized application that implements Leroy. And the beauty of that is that you can create user experiences that are really, or approximate kind of like traditional experiences. The website loads fast. It caches images. It caches like certain, non-critical data around the core data, which is like the content of your tweet that shouldn't be censorable. And at the same time, because that data is on the blockchain, you still maintain the trustlessness and ownership of your data. And so you don't destroy a lot of which we think about when we think about on a blockchain.
So this is kind of like a hybrid between a decentralized and centralized model.
Yeah, exactly. And I think it kind of takes the best of both worlds, right? It takes the trustlessness of the data. If the centralized application ever misbehaves and starts censoring people, then people are free to just simply launch another one, and the data still lives on the blockchain that can be surfaced. But at the same time, it creates a much better user experience for kind of like more mainstream users who might be trying to use it on the front end.
For sure. And now I'm focusing more on some of CoinFund's investments. Like you said before, CoinFund invested in YouNow, which is a video streaming platform that also has a decentralized platform for live video streaming that runs on a token called Props. And for our listeners at home, one of the usage of the Props token is to reward these content creators on the platform. But my question to you is, at the same time, right now you see these existing kind of popular live streaming platforms like Twitch, for instance, and they're not decentralized in any way, but they're still able to use fiat currency to reward their content creators. And frankly, they seem to have been working pretty well as well. So my question to you is, what is the most significant value add of using a token like Props and using a decentralized model for specifically a video streaming platform?
Yeah, well, so I think that I think YouNow's model is decentralized in the sense that it's creating a digital economy where many different companies and many different applications can coexist and sort of interoperate on the same network. So I think like one of the value propositions of blockchain, like open blockchain networks in some sense, is the ability to take what you have done on one platform and like fairly easily move it over to another platform. And so like destroying the silos created by these centralized social media companies, right, which purposely make it difficult to do that. I think, there's a place for a dedicated kind of digital asset for a particular purpose, like live streaming, right? Like, live streaming is an activity engaged in by millions of people all over the world. People love to, go on, create shows, play music. I do a show on Rise every Friday where I interview founders, much like you're doing. And it makes sense that, on such a platform, I have kind of a dedicated asset that allows me to keep track of almost like how well I'm doing, right? Or how much engagement I'm generating, and to be fairly rewarded, financially for the time that I spend. I think, excuse me. I think also the other interesting thing about YouNow's rise in particular is that there's an opportunity here to create a much more fundamentally valued digital asset than you might have otherwise. And YouNow is one of the few live streaming companies that has never really had an ad-based monetization strategy. The way that they have always operated is that users kind of have bought their digital assets, basically emojis on the platform, through the iOS App Store, right? And this has generated the revenue for the platform versus like running ads or taking people's data and selling them to advertisers for processing. And I think that's a really like kind of unique and interesting model. It shows that sort of this tipping of digital assets works in a live streaming context, whereas tipping, like in general on the internet, it doesn't work that well or hasn't worked that well so far. But I think we're kind of going into that world, but it's not a terribly successful model, today. And so what happens is that, there's an opportunity here to say, this asset is valued because we have a real generation of revenue happening, and we have a real cash flow. And this cash flow can be the source of funds, for like a rewards program, for example, on the platform, or to pay out creators. And that's something that basically YouNow has already done for a number of years, but limited to a small set of influencer or broadcaster partners. What cryptocurrency allows you to do here is to really widen that audience of people who can earn currency to a much wider audience, and thus the token valuation can happen much more fundamentally. It's not a speculatively traded asset. It's an asset that's based on real value that's being created by purchasers of these digital assets. And so I think that's a really cool value proposition that you don't really find in many apps. And as a final thought, I think that most mainstream users are not going to go on Coinbase and buy Ether. I think that's too complicated for them. I think it's complicated for them to use MetaMask. In fact, I think most people, thinking in the next, 3 to 5 years or something, the first time that they will get a cryptocurrency will be because they earned it on a user-facing platform like Rise, in exchange for engagement or for creating content on Steam and earning some Steam. And there's maybe about 10 applications that I anticipate this year where users are going to actually be able to do that.
Mm-hmm. And so for the sake of the argument, say I'm a content creator and I'm trying to stream a video show just like this one. What would you say is the kind of biggest proposition for me as a content creator to go on a platform like Rise, which is the streaming platform on YouNow, rather than, say, existing centralized platforms like Twitch or even Instagram Live?
I mean, I think there are two core value propositions if you migrate your show to Rise, as I have done. One is that you can be compensated for your time. Like, you're going to do a show, it's going to be live, there's going to be audience members, they're going to be sending you emojis. That's basically you generating engagement. The system will measure the engagement that you generate and give you a reward for that engagement. So, like, I can't name, I'm sure there are platforms, like YouTube and so on, where you can do that by generating revenue through advertising, but then you give up almost half of your revenue to the platform. You can be censored by the platform. And also, it's not a trivial thing to become a compensated broadcaster, right? If you don't have that many followers, you need a certain amount, something like 10,000, I believe, on YouTube to just even apply to that program. So on Rise, you're just going to be able to do that out of the gate. And then the second value proposition is more a feature of their product, right? This is a many-to-many live streaming video platform, which means that multiple people can be up on, broadcasting on stage at the same time. You could actually conduct interviews by having both of your video feeds side by side, rather than just, speaking and like switching screens or something like that. And furthermore, it's like super interactive. It's called participatory media, right? You can, and I do this all the time, I pull up audience members up on stage for them to ask questions of our guests. So it becomes like a much more interactive experience. People get to know each other a lot more. The viewers feel that they're really interacting with the guests rather than just being like a passive observer. And of course, that makes them want to reward you for the engagement that you're creating.
For sure. And I know CoinFund also invested in Kik, which is a Canadian messaging platform that raised $98 million for its KIN token in an effort to create a digital economy. So I'm curious about just generally, what drew you to this specific use case? Why a messaging platform?
Yeah. So we were advisors in the Kik project. Kik was really the first major VC-backed traditional consumer technology company to take on a blockchain strategy. We thought that was a really interesting value proposition. The reasons why Kik kind of came into that strategy are also very interesting. And yeah, let me not go into that part, but essentially it's around like the monopolization of commodity communications by giant tech companies that are incredibly hard to compete with on many different aspects, including technology, including being able to generate ad revenue, and at the end of the day, monetization. Now, the crypto economic problem of Kick also is extremely interesting, right? So this is a question around like, can a currency be sustainable while being sort of managed by a private company, right? And so, like, if an investor invests in in a fully decentralized digital currency like Bitcoin, you have many risks. You have technology risk, you have market risk, volatility, and on and on and on. But what the risk that you don't have is that some centralized company is going to go out of business and then tank the price of your asset. And so in Kick's case, it was sort of like an interesting problem to think about, an interesting problem to solve. And the solution that we collectively kind of came to was the Kin rewards engine, which is basically a reward pool that, again, is a network and that incentivizes different entities and companies and players and partners to integrate Kin cryptocurrency into their applications. And thus you distribute the risk away from like one central company to a number of companies like around the network. So it was, I think it is an extremely interesting project. I think they are, going full steam ahead, and they have developed that idea further and further. There's also scalability questions, and so they have integrations with Stellar going. They have developer conferences, one of which I spoke at and interviewed Fred Wilson at very recently. So it's a project that's still at very early stages, but I think it's really exciting.
Mm-hmm. And shifting gears to talk about something that I think not many people are as excited as I am about this. And this is your partnership with Venrock Associates, because as a venture capital nerd, I know that Rockefeller family's investments into Fairchild Semiconductors was widely known as the very first venture capital deal ever done. So now that they have partnered with CoinFund to invest in crypto assets, I think it is going to go down in history as one of the historic moments in the shift of venture capital. So I'd like you to talk a little bit about, what happened in the partnership, how it came along, and, what is the partnership? Like, how are you helping Venrock Associates?
Yeah, so we work most closely with the partner David Pacman there. David Pacman was an advisor to my company before I went into blockchain, but he also sits on the board of YouNow, which is how really we got to work with him very, very, very closely. David is great. He understands the space really well. He has an interview out on CNBC talking about Venrock's strategy and looking at the blockchain space and kind of how they're thinking about it. I think that he, coming from an engineering background, as a venture capitalist with that background, is particularly well suited for understanding that technology. And we have a great team rapport there. The partnership is around, it's around them kind of working very closely with us. They come from a very traditional, tech VC investing background, something that they have a lot of experience with. In fact, recently David was voted one of the top 100 venture capitalists in the world by CB Insights. We come from, a very blockchain informed and technical background, and there's a synergy between our teams and in terms of evaluating projects and maybe even co-investing in projects, but certainly mentoring teams and kind of working closely with teams. Those values really align for both of our organizations. The other thing is that Venrock was able to make an investment in our team as well and help us grow. I think at CoinFund, rather than being sort of a 2 or 3 person VC fund, which a lot of crypto funds tend to be these days, we actually have kind of a bigger vision and sort of more diverse vision around the initiatives that we want to do, and so we are kind of building a bigger team around that, and that investment certainly helped us get to the point where we are today, where we're going to have about 10 people working at CoinFund over the summer, including interns.
That's awesome. And the last 2 questions of the interview focus on you specifically or your experience in crypto. So I'm curious about what are some books or articles or resources that helped you out the most when you were first starting out?
Yeah. This is a really tough question for me because I've been like so removed for many years uh, from sort of like those introductory materials, and people ask me all the time, and I have a hard time coming up with answers. But essentially, it's really interesting to see that a lot of the early and even today research that's going on in blockchain really happens in social media. It's Twitter, it's Reddit, it's Medium, and to be totally honest, like the best stuff that I've read has been kind of this open source content on probably Medium and those other platforms. Chris Bernisky wrote a book, Crypto Assets. I think that's a great book that gives you kind of a general overview of the space and the issues. Great. That's one resource. There's also a website called, it's the Andreessen Horowitz's Crypto Canon, put together by Jesse Walden, Dennis Nazarov. I'm lucky to have my Fad Protocols is not an investment thesis article in there, but it's a great resource that has that covers like all of the issues like investment structure, like what are decentralized networks. I feel like that's a bit of a more advanced one, but anyone who's like a little bit technical or wants to persevere can kind of go through it.
Got it. And the very last question I have for you, Jake, is what is something that most people don't know about you that you'd like to share?
Oh, that's a good question. I've done like I'm kind of like a dual brain person, so I've done a lot of guitar playing and painting and poetry and stuff in my life, and in the blockchain space, a very technical space, so people tend to see my technical sides and not about my hobbies. So that's one thing I got called out on on a podcast one time with my friend Alan. He was like, "Tell us about all the paintings that you've been making."
That's awesome. Well, that's all the questions I have for you. Thank you very much for coming on to the show, Jake.
All right, cool. Thank you, Jason. I really appreciate you having me on.
And back to our listeners, thank you very much for listening to another episode of The Block Crunch. If you haven't already, please follow me on Twitter at Mr. Jason Choi. That's MrJasonChoi, because I share the latest episodes and updates there. If you haven't, please also rate and subscribe on whatever platform you're listening to this on, because it does help us get this out to more people and help spread the crypto virus. Once again, I've been your host, Jason Choi, and I look forward to seeing you at our next episode.